Hello, everybody. Welcome back to what is this? Live FOMC reaction with the Beamish. Ah, there you go. Let's see. Are we doing our thing? Oh, look at that. We're live on YouTube. I don't think anybody's watching though. We have a couple people here in the Zoom call here though with us. So I guess I'm talking to you guys here today. Brian Beamish, considering the ongoing tensions between Iran and Israel, there is growing concern that the situation might escalate further and drive oil prices up significantly. Uh, what's the next line? In your opinion, what would be the economic and geopolitical consequences for the world if crude oil were to hit $200 a barrel? Oh, that's an interesting question. Coming from Cypher. The only problem is what's real, which I know is kind of a cheesy answer. I don't really have it here, but let's give you an idea of what it is I'm talking about here before we get going. I would just call it FOMC chatter. Chatter. Good point. Be interesting to see what a crude oil price is in like real dollars. So the problem that I see, and this is my direct answer to you, is if we're dealing with this as a sort of and how would you describe it? A stable price, if you will. And you could actually believe these numbers over here, then I would actually think that seeing a move up into $200-300 a barrel, say up into this area, it wouldn't be good for the economy, that's for sure. It'd probably be like 1972, the oil shock, and that directly led to a recession. And you can just simply think of oil prices as a tax. It turns out the Arabs, and I suppose the blue-eyed sheiks as well, hell, even the maple syrup sheiks, I suppose, although the idiot who's driving the bus in my country right now wants to put the oil business out of business. But I would imagine all of those people will be much happier. Jesus, you think Dubai will be hot now? Can't wait till $200 a barrel crude, and Dubai will be hopping. The only problem is I don't know whether that's even a real image. And we're going through this great reset, that kind of nonsense. What is real? And really, I think now what you have to do is you have to divide this by the M2 money supply to actually get a real price for a barrel of crude oil. Now, you tell me. If we look at it, taking all the dilutionary effects of this insane monetary policy that this baby boomer generation is ramming down our throats. And keep in mind, there's a long period of time when it was like religion. You do not F with the money supply. Well, this baby boomer generation has gone and effed with the money supply. So with this kind of image, and keep in mind, this is the peak in oil prices just back in 2008. Does that look like a high oil price? Doesn't look like a very high oil price to me. So what is $200? Maybe that's what we should be asking. If you go to the grocery store, all of us know, God, 10, 20 years ago, especially when Lily was born, if I took $100 to the grocery store, I could easily buy, easily a week or two's solid supplies, diapers, everything. You go to the grocery store today, $100 doesn't buy you anything. I actually see, believe it or not, I see cuts of meat in the meat department that have over $100 price tag on the label. And you look at it and you go, what? What the hell is going on here? So it's a tough question to answer. Historically, you weren't supposed to F with the money supply. And so as a result, $100, wow, that's a lot of money. $200, wow, that's a lot of money. But nowadays, I don't even know what $200 even means. And if I look at that price chart does not look like a high oil price to me. So unfortunately, that's the answer that I have to give you is, honestly speaking, I don't think $200 is really that high of a price. And I suppose what's interesting is, there's your downtrend line. So we've lost that. And anybody, from a technician's perspective, anybody that's looking at this price chart should say, well, gee whiz, that sure looks like an inverted head and shoulders to me. Something along those lines. I suppose the key for the inverted head and shoulders thinking is you just don't want to see prices through that low. So what a surprise. Literally the moment that they brought it right down to that shoulder, all of a sudden a manufactured war just absolutely just pops up out of nowhere. And of course, anybody who's, a friend of Israel screams and yells. But as I said in the videos on the site today, I don't think there was a necessity to initiate this killing. I think that somebody was given a very clear message. Look at it. If you're going to do it, now is the time to do it. I did, I suppose as a complement to this, I did put out a price chart recently on USO, which is just the oil ETF. And if you think about that, inverted head and shoulders kind of thinking, it sure as hell looks like to me like a bullish chart pattern now. So can anybody predict exactly what's going to happen going forward? No. But I will say that sure as hell looks like a very, very bullish chart pattern. This is actually a really good analogy of where us technicians, we can kind of see the future in a weird sort of way. We study these price charts and price patterns and what's the probabilities and all that kind of talk. I think there's a very, very high probability that this oil ETF will go up and challenge the pre-sickness peaks here. I think I don't see why not. What's fascinating here, though, is you can clearly see there's a huge price gap here that needs filling in. So that alone should be a level, but also too, that should be a level. All right in there, all those price gaps, they should all be filled in. And really, horizontal support and resistance, this level right here should be a huge technical objective right there. And that's right up into that Alt ABCD level. And then, if you can see it, hopefully you can see that head and shoulders. It's a bit cockeyed on this. If anything, maybe, hopefully that's a good thing. I don't know. Something along those lines. All right. That's very cockeyed. It's not the cleanest. And I don't even know whether I would actually even consider this because it does look like these lows are slightly lower than these lows. But if you're thinking, if you do like working with inverted head and shoulders, our sort of resident head and shoulders expert, David O, he really likes to use the 1.618 as an objective of a head and shoulders breakout. And I think to a certain degree, you can kind of see that. So head, the other way I would do this is you want this to be sort of a symmetrical line. So wherever a right angle is off of that low, looks like a right angle's about there. So that distance to the neckline, and then project that off in the neckline breakout. And here we are. I would call this my parking garage right up in there. And then horizontal support and resistance, gaps like to be filled. I have a feeling that this is sort of a very different world when we were up in here. So I can tell you technically what I'm seeing, but how the world is actually going to react on a very specific reference to $200 a barrel price. My hunch is it will initiate a recession. Higher oil prices are a tax. But our charts here are all suggesting that it just looks like this has to happen now. Anyway, that's my comment there. Let's get back on task here. And Chris says that Mr. FOMC is about to talk. So let's pull that up.
Unchanged.
Do you have?
We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
So I'll put myself on mute, and
I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. However, surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy
That
strategy
means quite
and
useless.
communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Colby. Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had
Watch the
3
bonds
months
here.
of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effective tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
Bonds
In
leading.
terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chairperson Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjusted over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term. As you get out to the later years, it's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
You say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the war will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data including this morning that have been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point, it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate.
That's a whole lot of M's in the
all estimates are now
currencies.
pretty close together.
Bonds continue to head
It's highly
down.
uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
Yeah, what you start with is what's the effective tariff rate overall, and people are managing to that. But, you know, the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. You know, as you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamarosa of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the
Fed won't
2025
cut
projections.
until the market
I realize
breaks.
this is, you know, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts, and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, you know, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, you know, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period?
Bonds
of
are
very high
clearly
uncertainty?
stating
If
they
you
are
just look
not
backward
believing
at the
that
data,
rates are done going up.
That's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So
Ouch.
we'll make
Did you
smarter
just hear what he
decisions
said?
if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction. And I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
Look, From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with a strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are.
Well, then
not
stop
reappointed,
printing money,
would
you
stay on
fool.
as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Andrew.
Thanks, Mr. Chairman. I guess with workplace raids increasing, picking up significantly, what kind of effect would that have on the labor market in
Sorry,
the short
with
term?
what picking up?
Workplace raids.
So you're asking immigration.
Yeah.
You know, I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means, like, part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the unemployment rate in a reasonably stable place.
Okay, thanks. The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SCP that you suggested were part of the framework review, I think.
So the framework review really has two tracks, right? The first track is our policy framework that is reflected in the consensus statement. And we've said that we would finish that and announce it by the end of the summer. So we're well along in that process. We've had the meetings that we need to have, and we're now going to be going into, into discussions about, specific changes to language. So that's the framework part of it. The second part of it is our communications tools and practices. And that part comes next. Okay, that's what we're going to do in the meetings this fall. Actually, what we did at this meeting, though, is we sort of prepared the ground for that. We had a meeting where we talked at a high level about a number of ideas. The SCP is part of it. Many other ideas. It's sort of how do we think our communications can be improved? There are a number of ideas. People offered a really, it was a great conversation. Number of ideas, but we're going to look at those with staff briefing and a lot of thought in the fall. And I would say when it comes to changing communications, I would only support things really that only implement things that have very broad support. And also you want to be really careful because I think our communications are pretty well received. They're not broken. So more is not necessarily better, but better is better. So we're going to be looking at ways to do things that will improve the clarity of what we do for the benefit of the public.
Thanks, Chair Powell. Kelly O'Grady, CBS News. You're famously known as the guy that makes decision based on data instead of speculation. You've said today the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that
Bonds
you had rates
do
in
not
December,
like what he is
and there
saying.
was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today, and you didn't cut today?
Well, the forecast for inflation in December was 2.5. Core PCE for 2025, the forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be, we've learned that the tariffs are going to be substantially larger than forecasters generally thought. And we don't, our forecasts are generally not particularly different from those of other well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming and that would mean higher inflation. That's what happened. And so now you see You saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans. Small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. Best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our
Oh, I like
best thing
her.
we can do for
She's
the American
sharp.
people, for households and businesses. That is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now. And inflation is 2.3% headline inflation over a 12-month basis.
Yeah,
So
4.5%
it's a good economy,
is
and a solid
not
economy with decent
restrictive.
growth.
What the hell is restrictive then?
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant, everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs, because someone has to pay for the tariffs. And it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind, or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's
That's
what
assuming that
businesses say,
the
that's what
consumer
data say from
continues
past
to
that.
buy the
So we know
tariff
that's
product,
coming,
but what happens if they
and,
don't buy the tariff product?
We just want to see a little bit of that before we
This
make judgments
guy's
prematurely.
cheeky.
And follow up on that, so you
This
spent
is
years
exactly
talking
the
about
same
how you're
thing
data-dependent,
as
and be a little
them
more direct on
saying
this.
inflation is
Now you're
transitory
making
through the
decisions
sickness.
looking forward.
And-
Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. But we say that over and over and over again, right? So it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment, you talk to business people now,
We
there's a very
knew
different
things were
feeling
gonna
now
be
that
really
people are
bad.
working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokway with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no, and I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we do, we work hard, but I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public, we're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1%.
No, you're not.
So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think
This
this
YouTube
is
delay
without
sucks horse
taking risk
roosters.
to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it, again, respecting that we have critical missions to carry out. I've had experience, a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions, and I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we just
Professional
want to show
what?
that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're gonna hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections
Oh, I
for
like her.
2026 and beyond. Thank you.
Yeah, so, we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous, and so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate, but it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil. Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks, and worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are
You know
reliable
he's
right now?
lobbying to kill this big, beautiful bill.
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult, and it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
Victoria. Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review.
And yet you've consistently gotten it
but next
wrong.
year we're supposed to have a new Fed chair. And I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be
Somebody
durable?
buy this guy a lozenge.
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think anybody.
It is TBD.
I've never heard anyone raise
It
this
is.
issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But but that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Thank you. Chair Powell, Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation? And what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle
look at the
East, you
oil
always see
coming
a
off.
spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology
Wrong.
executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points, because, AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with it, with AI, will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. That, of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Greg.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change.
That copper price move is
akin
huge.
to the end of the Bretton
Something
Woods
happened here.
era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to change how the movements of the dollar was impacting the economy. Are we going through something like that now? That, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change.
Nice.
From a geopolitical
Someone finally
standpoint,
talking
from a
about
trade
this.
standpoint, from an immigration standpoint. You see this not just here, but everywhere. So there's quite a lot.
The Great
going
Reset.
on.
This is it,
It doesn't change
folks.
the way we
This
do
is your
monetary policy in the
inflation.
near term. But and it doesn't change our objectives or what we need to do. And these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. Will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know though. So, but you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Mark. Mark Hamrick.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. At the margin.
There's your
remember, you're
inflation,
at
folks.
4.2%
Right there in
unemployment.
Technicolor. And
For
he
many,
won't
many years,
talk
that
about
was
it.
an extremely low level.
Crooks.
It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but those are good numbers. So it's a pretty good labor market. There's a more concerning thing is There are not a lot of layoffs, but there are not a lot of job creation. If you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very, very carefully, because if there were to be significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken, really, over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Go to Jean for the last question. Hi, Chair Powell. Jean Young with MNI Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, think of it as the least unlikely path in a situation like this where uncertainty is very high. I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime, we do the best we can with these forecasts, and I think they're representative of the different forecasts and different reaction functions that people on the committee have. So thank you very much. Thanks.
All right. Wow, that was fun. Was interesting to see right out of the gate, the bonds just puked right out. And of course, Fed can't cut rates. It's probably a hard thing for the public to understand. I guess I should mute myself. There's no way that the Fed can cut rates on their own. In fact, what they actually do is they follow the market. And probably the easiest image for you to see that is always a challenge to get these silly charts correct. FOMC. No, I don't think that's it. What is it? It's Fed funds. Yeah, so many darn charts. There we are, 4-year cycle. So it's interesting, if you're watching path of interest rates and what expectations, probably the most important chart on this entire image following the Fed is this one. And the reason why, of course, is because the Fed is this dark blue line, and this yellow line is that 2-year bond. So you notice the Fed got all freaky and took rates down to 0 when the 2-year bond just started to go absolutely crazy here. Then the Fed comes in and panic. Oh, we're going to take rates to 0. So really, they're following the lead of the bond market. I think that's a misconception. I think a lot of people in the public just don't understand. The Fed is not. There's no way they are big enough to actually move the market. They can in a short term. And, in the great financial crisis, they literally took the entire market and just put it over on this side balance sheet. And and they kept rates very, very low. So while all those bonds were still on the balance sheet, they didn't go bankrupt, because there's no way they could have paid today's rates on all of that bonds that they had to sit there and hold, that were basically worthless. So here we are, and somebody had commented on the YouTube page, probably no altcoin stupid, insane bull markets with rates where they are. We had, you remember there were those characters on YouTube that were like the young generation new capitalist. I have funny names for one of the Facebook founders. Everybody on the site, of course, knows what I like to call him. And now, ironically enough, they went ridiculously balls deep into all of the speculative part of the market. And they were all like uber long China and all that nonsense. As soon as there was actually cost to money, and money is no longer free, then all of that fluffiness just disappears. And sadly, I hate to say it, but a lot of the projects that you hear about in crypto, I think they fall under that same sort of umbrella, kind of the fluffy part of the market. So with a cost to short-term borrowing, there's money actually costs something. Yeah, unfortunately, the speculative part of the market's not probably going to do very well through this. I would actually argue too, and I did hear through that. Yeah, I know. I'm not going to go there, Cole. This is a public broadcast. No, I lost my train of thought though. Thanks, man. Anyway, do we actually see this push up here and get these rates down to like historic levels again? I don't think so. And if anything, I actually do like the idea that Mr. Powell here is anticipating that Mr. Trump's going to put in somebody when he leaves that is, let's just say, more market friendly, if you will, and maybe not so much a puppet of the Rothschilds. And if that's the case, then I think that will be very inflationary. And to a certain degree, I think Mr. Powell's he's trying to front run that. And under his stewardship, he doesn't even want that to even be a consideration. But his term's over in a year or so, and my hunch is that in a year or two, this will be heading lower under the new leadership. And the scary part about it, and you notice that one commentator, financial journalist, I didn't catch his name. I've seen him around for years, but he was the only one who actually connected this whole Great Reset crap and what's going on here, the M2 money supply printing. The worst part about this is, as technicians, we actually, and that's funny how I've been saying this actually quite a bit lately, which is kind of sad. But, we, kind of like what you saw with that oil price, is we can kind of see the future. We know what's going to happen, but we just don't know why. I will say though, and I'm not quite sure if this is the best link. I mean, there's a bunch of these to show you, but that gentleman, he literally hit the nail on the head with regard to what's driving policy right now. We are in that great resetting. You can see this was the last time we went through one of these great resettings. And you can see 1940s, inflation was very, very low, 39. We were deflationary. That's exactly the same thing we went through, latter part of the 20 teens. Then all of a sudden, mysteriously, in 1941, 1942, inflation started to get pretty ugly. And then it backed off. And interestingly enough, it actually got to sort of a low point, where I guess is our lowest low here, in 1944, actually hit zero there. Was that 2024? after the Fed had cranked interest rates up. And socialism was basically told to go itself. Unfortunately, socialism is absolutely rampant in Europe. It's rampant in my country. I mean, it's shocking the way that the political leadership just doesn't give a F about poor old consumer getting destroyed here. I would say that the last domino to fall in that pyramid is going to be the United States. And when they acquiesce, interesting how Mr. Powell's term comes to an end in 2026. But you can see if we think out 2027, 2028, I mean, look at these numbers. Life is going to get extremely difficult for us. It sucks, but this unfortunately is one of the bad side effects of being good technicians. We respect historical data. And as I said there a moment ago, and while the gentleman was actually speaking, I chimed in there, holy crap, this is the first bloody person who's actually trying to talk about what's really going on here. And you want to know what inflation is? This is what inflation is. You're not supposed to F with your country's money supply. But this is exactly what they've done to us. And, for all the Donnie lovers out there, don't kid yourself. I mean, I find this hilarious about this whole anecdote. Look how the money supply went absolutely insane here. And oh, by the way, Donnie was your beloved leader. Ironically enough, Mr. Biden, he just inherited this mess. This is, of course, where the Fed, and Mr. Druckenmiller, who's a gentleman that I absolutely respect, he came out here and he's like, you're going to destroy our country. What the hell are you idiots doing? And so after him bitching and complaining enough, the Fed actually got some religion and said, you're right. We should really, we should be thinking about the actual people we're supposed to be serving. And this is what disgusts me about him standing there up on that stage and talking about, our mandate is to serve the public, and that's our number one horse fucking shit. That's just a load of horse hockey. Now, their interest is, and think about it in simplest terms, their interest is the Federal Reserve Board specifically, they are clients of the industry that they serve. What industry do they serve? They serve the banking industry. So the worst part about this is that you can clearly see something has changed here since beloved leaders have now been replaced. Well, I guess you could argue probably since last year. These guys have turned the printing presses back on, and even under your dear leader that all of you mega people love so much, inflation is not going away. In fact, I would argue we're now confirming another breakout in the inflation picture. And ironically enough, you even heard one of the reporters say, well, we actually kind of felt like we had a little bit of a reprieve from this nightmare of inflation when energy prices started to actually come down. And frankly speaking, this is our reprieve from that inflation. But look what's just happened here. And then Mr. Powell has the audacity to say, well, energy prices are transitory, just like the inflation through the sickness. Whatever. Now, Brian just talking out his butt here. I vehemently disagree with that thesis. I couldn't disagree with anything more about these damn central banksters and what they do than this idea that energy prices are not the primary drivers of inflation. So, long and short of it here is whatever sort of break the consumer got, that is being quickly taken away. So, he's sitting there going, oh, inflation's under control. Inflation's doing good. Inflation. Well, that's because energy prices were falling for 6 months, but clearly, boom. And before we got going, you heard me ranting about my expectation for energy prices going forward. And then sadly, of course, this fits right into the model of what the Great Reset and the banksters' plans are for us. So a little disappointed when you listen to these guys up on stage talking away, because really a lot of it's just bullshit. And in fact, I hope to consider him a friend. I highly respect him as a market technician with me. In fact, we have regular meetings. Had a really great meeting last night. Thank you very much, Cole, for participating. But Cole said there, interesting Bretton Woods coming up, given where we are in the 84-year cycle. Hats off to that one guy for having the balls to actually stand up and say that. Actually, I don't think he stood. But about one of the only people in that entire room, including this beloved chairman, although I think half the time he's lying to us and he knows that he's lying to us. It was interesting. One of the people in the little video Zoom call here with us, another one of our OGs, he actually posted the cough could be a secret code signal. And frankly speaking, I think it is. I think that I used to be a financial planner and have to sit down with people and do interviews about their actual real financial circumstances. And then, of course, recommend a course of plan. And I could always tell when the husband was lying about finances, because he would do things like, while you're talking, you cough to try and distract, subconsciously try and deflect attention away from the lie. As well, people have a bad habit of touching their face when they lie. And you can always tell the bigger the lie, the higher on their face they touch. So if they just scratch their chin, oh, it's a small lie. If they rub their forehead and are like, oh man, it's a big lie. So I actually agree with you, TBG. I do think that cough is a subconscious. If anything, I almost think it's his subconscious himself trying to deal with the fact that he is so blatantly standing up there and lying to the American public about what their agenda is, what their policies are, who they actually serve, and what their ultimate goal out of all of this is. And ironically enough, I actually think Klaus didn't do any of these one percenters any favors by actually coining the term the Great Reset, because that's exactly what's going on here. And it's exactly what happened in the 1940s, as well as the 1860s, as well as the 1720s, or I guess 1710s or whatever. But the point is that this happens every 80 years. They have to do this Great Reset to basically continue the facade of what our society is basically built on, and that is basically never-ending piles of debt. Oh, well. It's probably not the most cheery of conversations to have with all of you. My apologies. It was interesting to see how crude prices broke about halfway through that conversation. Where's that screen? Oh, did I get rid of it? That's weird. This is my higher time frame charts. No, it isn't. Oh, that's weird. I don't know why I had that on daily. It was interesting to see how crude prices broke about 3/4 of the way through that conversation there. That actually surprised me. And you saw, as soon as energy prices broke there, what happened with the bonds? They finally started to lift. So I thought that was actually an interesting development through all of this. That as long as energy prices were really high and not really going anywhere, and there's unleaded gasoline prices, the bond market and interest rates were continually churning higher. And all of a sudden, out of the corner of my eye, I saw the oil market break there, and then the bonds jumped up. So if anything, that is a perfect testament to the fact that energy prices are the most important thing here with regard to interest rates. And ironically enough, the market drives interest rates. And as a result, the Fed has to follow the market's lead. If this 2-year bond cannot lift, if it cannot break out, then there's no way in hell these Fedsters can move interest rates lower. So really, what we need to do is we just need to follow the bond market. Suppose just a 64,000 foot view of what's going on here. If we zoom out a bit, for anybody who doesn't follow TRI, I actually am firmly, if anybody's watching this video, but actually it looks like a whole bunch of people just left listening to Brian's rhetoric. So that doesn't surprise me. It's just TRIers now watching this. I might make the argument that we're actually setting up for another leg higher here in the stock market. So I don't think that the bull is over just yet. But I definitely think, and I wouldn't be surprised if we have like a 90-day tariff hiatus and those kind of talks, maybe like a 90-day hiatus on Iran and Israel, because Iran says that they'll come back to the table. And then in 90 days, they tell the Americans to F off again, blah, 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 blah. I still think that there's another push higher here in the market. And one thing that coming out of this conversation today that caught my attention is, what does the professor of economics think here? Now, I don't know whether the professor of economics, I don't know whether a lot of you follow the professor of economics, but you heard through that conversation, I perked up when I saw the copper market break out here. You can see clearly gold is not happy with what Mr. Powell is saying. Silver as an industrial metal, not happy. But interesting to see how copper prices, as a function of the strength of the economy, copper prices actually are still very firm here. So I do think that the professor of economics actually is relatively happy here. And you can see the professor is continually making higher highs and higher lows here. And if you're a fan of the economy and the growth of the economy, you want to see copper prices continuing to move higher here. But at the same time, too, that's inflationary. I mean, when I first started in the business back in the 80s and 90s, we always said that copper prices were trapped between 65 cents and $1.20. You see this price, $4.65. If that isn't a perfect anecdote of the inflationary world that we live in, i.e., the actual value of money itself has absolutely collapsed because they just have runaway printing. Well, that's a perfect analogy of the world that we live in. Having said that, I don't see any kinks in the economic picture here. So as I had said, I actually still think we are going to push our way higher here. What will be really interesting to watch is how where the hell am I? Well, yeah. I mean, let's finish this up. I could go on a half an hour with all of this. Interesting. Look at all the these are the bond prices. 30-minute chart. Look how that 2-year note on that announcement, it puked out and it put in a big old fat M. And you can see how these bonds are just not very happy here right now. Interesting too, on the bond market break, look how the stocks went, oh crap. So you can see that the stocks are also watching the bond market very, very closely. And I might make the argument that stocks really, to move higher in earnest, we need to have these bonds get a little happier. It's interesting, Cold had made reference to Mr. Hendry's big trade. He is uber bullish of the US long bond. it's an interesting trade location that the bonds are in. Reload zones within reload zones, all that kind of talk. And we at TRI have been just humming and hawing about whether we can actually get a bullish market structure on the other side of this very, very important trend line. So it was interesting how the market popped on that energy weakness. As soon as the energy market started to come back in earnest, the bonds crapped back out and lost that trend line. Look how important this trend line is. This is actually, and this is where they say, oh well, we at the Fed, we do everything in the best interest of the economy and the consumer. Horse fucking shit. Janet Yellen, who's basically a Fed lifer, she had the opportunity here to roll all of the US long-term debt into like 30-year paper where at like historically low interest rates. But what did she do? She actually rolled all of the US debt into 2-year notes and 3-year notes. So because she knew that this big drop or fall in bond prices was coming, if she had gone and rolled all that debt into US long-term bonds, the US would be absolutely laughing right now. But because she put it into 2-year paper, now the US has to refinance at these much higher rates. So don't for a moment believe when the Fedster says, the Fed, because keep in mind, she's a lifer from the Fed. And I think that she was literally put into that position following Mr. Bernanke's exit. But anyway, the point of the matter here is Mr. Hendry, and rightly so, I think there probably is some sort of trade here. I'd like a move back up here in the bonds, but it won't happen until we actually start getting structure on the other side of this trend line. And I think the jury's still out right now. My hunch here is that when the Fed actually comes out and says, all right, we've got our head in front of the inflation problem, and now we have to worry about the labor market breaking because the labor market is collapsing. So we've got to lower interest rates. Then you're going to see your 2-year note take off like a rocket. And that's when the Fed will be officially allowed to start lowering interest rates. But I don't think that's anywhere near here right now. So Mr. Hendry is, please, can this damn thing bottom? Can the US market break? Can we get some sort of crisis? Because keep in mind, the Fed won't move until there's actually some sort of crisis. As long as there's no crisis, they will keep interest rates higher for longer. So anyway, blah, blah, blah. Hope you got some value out of all of that. I will say absolutely, though, excellent comment from one of our longer term site members about the oil market and what's the world going to look like if this oil market does crank higher in earnest. They always say volume speaks volumes. You can see the buying just pouring in here now. And I hate to say it, but I think energy prices have to go up. The Fed has basically said, we are printing money. Get used to it. You have no choice. Poor suckers. You even heard him say, the only relief that the economy is going to have is if you go get a job. You're not going to see prices go down. In fact, there was even one specific line that he said in there that prices will not go back down. And God, I can't remember what it is. I'm going to have to go back and listen to it because it was a really, really important line. It was only like maybe 1 or 2 seconds, but he actually sort of gave up this secret that they have absolutely no intentions of prices ever going back down again. And if they ever do start going back down, that's when they will start cutting rates. So anyway, crypto, finish all this off. I suppose if gold's kind of heavy, then the propensity to buy Bitcoins as an inflationary hedge is probably also a bit iffy. It was interesting to see Ethereum tried to turn here. I think Ethereum is a really, really good proxy on sort of the venture cap part of the market. So if you do see this stabilize and actually start to break out through these highs here, which appears to be, keep in mind, this is a very lower time frame basis, 3-minute chart. But if you can see them take this thing above, what's that number? 25 and 12, we'll call it. I think I actually got some structure to work with. Was interesting through the whole speech. I was watching Bitcoin really closely as to whether it would break this key support. You notice like things like the euro, that's that same low. So interesting how Bitcoin could not break through that low. And yet the euro absolutely puked out. The Japanese yen absolutely puked out. The Swiss franc, interestingly enough, Swiss franc, of course, is your proxy on the gold market. It absolutely puked out. This is another reason why I don't think gold can go higher here in the short term. You can just go currency after currency after currency. This low was critical. And of course, remember I had said, when that low was taken out in the bonds, and more importantly, I mean, look at this bearish structure in the 10-year off of that low, on the 5-year off of that low. When this level was breached, that was a major, major signal to the market. So I am sitting here a little bit curious as to why crypto did not break those lows. And does this have something to do with Mr. Fink? I actually outlined in detail in the daily brief today that I actually think that the Bitcoin price is being highly, highly manipulated here. So, June is a quarterly options expiry. It is a very, very big contract expiry month for anybody who trades the derivatives markets. Triple witching, they'll call it on Friday. It's interesting how we have a manufactured holiday now the day before that expiry. Was that done on purpose? I think so. We often see that through these holiday markets, these central banksters, they do some really, really sneaky stuff in the market. Regardless, I think that this $60 strike on this IBIT, the iShares Bitcoin Trust, I think this is a massively important level. And interestingly enough, I don't think Wall Street really wants to pay a lot for Bitcoin here, but I do think that Wall Street wants to get long Bitcoin in size. Why? Well, I mean, God, how long have I been barking at all of you about these 4-year cycles? 1.382 is a very, very good reference if you're a fan of fib time zones. 1.382 was our cycle peak last cycle. 1.382 was our cycle peak through Donnie's first go run in the market. Hell, 1.382 is an excellent cycle peak reference going all the way back to 2014 and Mt. Gox shit. So why would this year be any different? Keep in mind that this image, this 4-year cycle image and the crypto seasonality, this is directly tied to this 4-year money cycle. They're exactly the same conversation. I think this is exactly why Bitcoin was put in the white paper and the halvening and all that. I think it's exactly why it was put on this 4-year cycle. It's basically just following the cost of money. So do you think Wall Street, do you think Brian Beamish is that smart that he's figured something out that Wall Street doesn't know through the yin yang? I mean, everybody, Taco's treasury secretary. I'm a hedge fund manager. I'm all about risk, right? And of course, Fink coming in on Bitcoin and floating as ETF and basically taking over the story. They all know this. So the point I'm trying to make here is that this is a huge, huge event here. This dotted line. If we actually close above this line, then it means that this 54,000 put options at this 64, and that represents 5.4 million shares of this Bitcoin Trust. 5.4 million shares at $60. Is that any money? 60 times 5.5 million? So that's like, I can't even count that high. 300, $400 million. Did I get that right? Maybe I might have missed a digit. I think that's right. That's a hell of a lot of money riding on the line here. Basically, $333 billion is riding on this one strike price, not including all of these strike prices that are going to basically expire in the money if the market just goes out anywhere around this $60 level. That's a lot of money. And then notice above that, the open interest just drops appreciably. So what this tells me, and keep in mind, most institutions write put options. Retail, you and I, we don't really write put options. This is all institutions. Over on the call side, there are a lot of people that write covered calls, but at the same time too, this is 77,000 contracts. So if this actually expires in the money above $60, then it means Wall Street will not be buyers, and all of these options all expire worthless. Wall Street makes an absolute killing on premiums, but they're not long Bitcoin. I think they want to be long Bitcoin, and I think they are going to manufacture maybe 59.75, 59.80, somewhere in there. If that happens, then this strike price automatically exercises. And if they do take it out at 59.75, then that means this $60 call and all of these calls all expire worthless. And whoever wrote them, probably a lot of institutions, they get to collect the premiums. So I believe that the reason why you see Bitcoin at its current price, and basically my conversation on the site with site members is, I think Bitcoin's basically parked here. And hopefully with that conversation about the massive implications of where this market goes out day after tomorrow, you understand why the price is parked here. I don't think it's an accident. Having said that, I also don't think that we're going to see too much of a range expansion here until we get comfortably on the other side of that expiry and maybe even into the weekend or something. I'd also say too, with regard to crypto, because of Taco and his morally irreprehensible behavior, a huge part of your crypto market is simply going to be driven by what this silly, worthless meme coin is doing. If you see that this meme coin is rallying and Taco, of course, is basically pumping his bags, well, probably the whole crypto market does well. If, however, you see this thing's fading, and oh, what a surprise, what a great analogy of buy the rumor, sell the news. Once we got on the other side of this crony capitalism dinner, which was such a scam, it was ridiculous. And even the people at the dinner go, man, and even the food sucked. But as soon as that was done, literally, he just walked away from this market. So ironically enough, if you want an actual tell of when your shit coins, your altcoins, all that kind of, yes, Cole, Cheeto Jesus is Taco. And I like the name Taco because Wall Street gave him that name. So if Wall Street gave him that name, I like that name. It's perfect. And you see everything he's done, even what's going on with Iran today. Same thing. It's a total taco what he's done. Right. And I'll leave it up to you to figure out what Taco stands for. But the bottom line here is I don't think that your crypto market really gets going in earnest until Taco starts pumping his bags. And it might even be Taco's kids. Who knows? So anyway, there's your market summary for me and sort of my outlook for what I expect to see here in specifically with regard to crypto over the short term. All right, everybody. I hope you enjoyed that. Have yourselves a great rest of your day. PMA for the win. Slow and steady wins the race. Try not to take any of those wooden tacos. Wooden tacos, they're terrible to eat. They just don't go down very well. So hopefully I gave you a little bit of food for thought and some things to think about. All right, all the best, hugs and kisses. And the only thing left to say to you good people is bye for now.